Gurpreet Narwin for more on the decision to hold interest rates. Gurpreet.
Yeah, hi, Sophie. So this decision hasn't come as a major surprise. We were all expecting the Bank of England to hold interest rates at 4%. And you might remember that comes after they cut rates the previous month. And you can see there the charts on the screen, how after we came out of the lockdown crisis, inflation started spiking, and then the Bank of England consistently raising interest rates every month to a peak of about 5.25%. But then the journey down has been a lot slower, a lot more protracted, and that's because inflation is proving a little bit more stubborn and difficult to get down. You might remember comments from Andy Haldane, the former chief economist at the Bank of England, who said inflation is a tiger that once it's out of the cage, it's really hard to get back in. And I think that graph illustrates that. Now, I think what's super interesting about this decision is it's not the headline rate, because we were expecting that to stay at 4%, but it's the split. So the voting pattern. There are 9 members of the Monetary Policy Committee. They come together every month to decide what to do with interest rates, whether to hold them, whether to cut them, whether to raise them. And in recent months, it's been a little bit more difficult to reach a consensus, to chart the correct path on monetary policy. And we've had the data just in, and it's not a huge surprise. Unchanged, 7 voted for rates to remain on hold, and then 2 voted for a cut. Perhaps they're a little bit more cautious about some of the data on the economy, on the job side, fearful that another pause on interest rates could cause further damage to the economy. But a bit more of a consensus today. In previous months, the decision has been a little bit more fraught, especially last month, because last month they had to go to a revote. 4 members of the committee chose to keep rates on hold. Another 4 voted to cut them by 0.25%. And then another member, Alan Taylor, an external member of the Monetary Policy Committee, voted for an even bigger cut of 0.5%. I'm pretty confident he's one of the ones that voted for a cut. Today, we're also hearing from the bank some news on quantitative tightening, so selling gilts back into the market. This is when quantitative easing was taking place. The Bank of England was buying up gilts to help shore up the economy. And the bank has voted to reduce the stock of UK government bond purchases held for monetary policy purposes. And so that could have an impact on the gilt markets. We'll have to wait and see what the outcome of that is. Just confirming for you that those 2 members who did vote for a cut voted for a 0.25 percentage point cut to take the base rate down to 3.75%. And they will be worried about what's happening on the economy side. So signs that the jobs market is slowing. We know that we've got stagnant economic growth in the UK. But the other 7 will be more excised by what's happening on the inflation side, because we know that inflation is sticky at 3.8%. The bank thinks it's actually going to rise, hitting a peak of 4% before the end of the year, before coming back down again. But inflation, has a habit of getting away from us. It can be a little bit unpredictable. And if we're looking at what's driving inflation at the moment, we've got utility bills, higher utility bills. Most people will recognise that will have recognised that from April. But also part of this is food prices. So food price inflation is a major cause of this. I spoke to Andrew Bailey, the Governor of the Bank of England, about this last month. And, we were talking about some of the reasons why food prices are climbing. Some of it is global factors. So things like poor harvests are playing a role in this, but also government policy. So some of it is about changes to packaging rules that are forcing retailers to put prices up, but also government policy increases in national insurance contributions.